Hello, YouTube. This weekend, the S&P put in a violent stock market bounce, putting in a bullish engulfing candle, which means that we went to a lower low and to a higher high, and we are closing at the high over last week's high as well. This is generally going to be quite bullish, and you might be wondering why I'm saying this, because I've been beating a pretty bearish rhetoric for the last couple of weeks, and that's just because as the tape changes, so does our perspective. We note that on Tuesday, we were actually below last week's low. Looked like the bears were in full control. And at a certain point, we have to realize where we are wrong, because our goal is not to be perfect. Our goal is to make profit. So this weekend, that's really what we want to try to figure out, because the stock market is acting right around math numbers. I'm talking about a Fibonacci retracement. And we note here that once we went above 389.6, our low of the week is at 388.42, within $1 of that Fibonacci level from our all-time high down to our 2020 low. It went right up here to close at roughly 406.87, which is going to be the 38% retracement from our all-time high down to our low of the year. So if the market is doing very predictable moves with math, are we going to push up to the 0.5 area? And the reason why this one is so important is because when we had the statistic that when the market drops by, goes into a bear market, reclaims that 50% retracement, the odds are like 80%, 90% that it just goes into a new bull market. We clearly didn't do that. So we had a pretty big corrective wave. I think we even had a correction, which is going to be -10 off the high. Did we get a technical correction? Let's just do the math here really fast. 431.7 times 0.9, 388.53, 388.42. I didn't actually even do that before I started recording. So we got a -10 over here. Oh, okay. So we got a -10 from our high to our low, and then we bounced. And we bounced up by, from low to high, we're now up by about, I don't know, about 4 or 5%. Let's just do the math here. Yeah, it's about 4.6%. So we took about 20 steps forward, 10 steps back, 5 steps forward. Is that enough progress? Let's look and see the reason why we actually went up this week. So the reason why we went up this week was that forced buying puts a floor under stocks nobody else wants to own. So I think that people watching this video, which are largely going to be retail, means that they're going to be happy, because these are generally stocks they own more of, like Bitcoin, which was up nearly 10% on Friday, or a lot of Cathie Wood stocks, a lot of growth stocks. And they went up a lot because no one else wants to own them, but you do. So when we think about that, short sellers, options, hedgers, quants seen driving an up week. And if we know that the market generally does what we expect it to, isn't this what we would expect if we got a bear market rally? That it would be fast, it would be dirty. And yes, in a short and trading week, we're up by 3.6% on a closing basis. That's pretty big. And that's the first thing I wanted to point out here. Second thing I want to point out is that you're probably noticing competing views out there in terms of fundamentals, in terms of technicals, in terms of sentiment, or what people are saying on the YouTubes or on the Twitter. And that's because the market is choppy. Choppy means that we are in a kangaroo market. So for me, on a weekly closing basis with the S&P below 405, that is bearish. From 405 to 435, that is a kangaroo. And over 435 is bullish. And yes, for me, it is literally that simple. So during the week and on the weekends, we prepare videos to try to get our best guess of what is probable, not what is possible, but what is most likely going to happen. And as we are proven wrong, like when we get back above 395, which means that we are in a monthly, we're back above the monthly low for the bears. That means you're wrong. And getting a warning at 395 is a lot better than realizing on Friday, they're like, oh my God, it's 406 and I'm wrong. So as the data changes, we have to readapt. So another way to look at the data that I think might be relevant here is just looking at the monthly chart. So if we note here, I'm not going to put my lines back because it's going to get a little bit confusing. But all I want to show here is just that. Actually, is it helpful? Maybe. Red means resistance. Green means support. There's more red lines, which means there's more resistance than support. And if we look at the month here, our high was established in June at 417. Then we got 413. Then we open at 409 in August, but we did push to a higher high. And now we got a lower low and a lower high into September. So what that means is that the path is currently down. We tried to go up in August. We failed. And now we're trying again. It's literally that simple. We're trying. We're not succeeding. And the reason why is because we have more red lines than green. So for me personally, I think this might even make it easier for me to trade, because when I look at the red, it means the dominant pattern, which has more lines, is red. We're in a red funnel lower, but we do have support, which is exactly where we would expect to find buyers. And we did this week, exactly where we would expect them to. So if we find sellers exactly where we would expect them to, and now we're looking for buyers to show up exactly where we'd expect them to, does it kind of make sense that if the levels are holding and we're playing out the pattern, that we just let it play out? And when it's done, or when we get to the next resistance zone, that's where we really watch for a pivot. And I think the reason why we have to be aware of this is because we're back above 405 to 435, which means, yes, if we fall back below 405 by Friday, for me, it means we're flip-flopping between a bear market. If we get back above 435, which is about 10% from here, it means we're going into a bull market. And I think the reason why this is important for this week ahead is simply because if we get these numbers on Tuesday, Wednesday, meaning a negative 0.1 on a CPI and negative 0.1 on a PPI, I think, not I know, I think that this might be interpreted as peak inflation. Why? Because we're trending down. We have some charts to support a little bit later in the show, but this is what I think the market is building up pressure for. It started off with people who didn't want to buy, short sellers, right? Option sellers, quants, people on the wrong side. They were buying the stocks no one wanted. And now as we go into Tuesday and we look at our weekly chart, as I mentioned, yes, this is a pretty bullish candle. We have a weekly bullish engulfing candle, which means we're closing within, I don't know, like within $1 of the high of the week. When the range is 20 points on a $400 stock, whoa, that's a 5% range. Yes, sir. So closing at the high of the week, being above last week's range, being above the previous weekly close means that there's pressure building up on this weekly closing basis. There's not volume, but it's a shortened week as well. So now if we look at, okay, well, if the catalyst is Tuesday and then on Wednesday for confirmation, if the bulls are going to clinch this to go higher, we want to see that confirmation going into Wednesday, which just means that we have a chance to shoot up here to next week at about 425. That would be a total upside target. I would also note that visually, I've put on my support and resistance on the chart. Green, meaning the weekly support, and red, meaning the weekly resistance. I also have this number right here, which is negative 10, which corresponds with 431.98. And the reason why that's important is because I showed you that for a kangaroo market, I'll just briefly explain the reason why below 405 and below 435 are the reasons why I believe that is a bear and a bull, and why in between it's just choppy. So for the upside, for us to get back above 435, it means that we're breaking our downtrend. Let me get rid of all these lines now. So let me just show you for my bear market target. So if we're above 435, it means we are first of all above the blue line right now at 430.49. That is our 50 moving average. And I've been using this this chart here to show, hey, if we're repeating 2008, all we have to do is fall back below our, oops, let me get rid of that line. All we have to do is go back below our 200 weekly, and we have a head and shoulders, knees and toes. It's that simple. So we have a head and shoulders. We hit the 50, bounce off the 200, reject off the 50. We're about right here right now. We put in a green candle. Yeah, is it enough? I don't know. So if we lose the 50, the 200 weekly and make a new low of the year, that's where we're probably going to get our negative 50. And as of right now, if we go back to where we are here, the pattern is still valid. But again, with a 5% week, do you really want to be on the wrong side of the trade the whole time? I don't. So when I'm looking here, I'm like, okay, well, head and shoulders. And then I added in the lines that we have from the other one, the red funnel and the green support. There's much more red on here than green. But as long as this trend line is not violated, we will coil up and decide going into late October where we're going to go. Are we going to coil up and go down? Or are we going to coil up and go up? The simpler we can make the story, the more likely we are to understand it. And if it's going against us and we're on the wrong side of the trade, it means we're likely going to give up before the point of no return, meaning your account has gone bye-bye. This is important because retail traders now have a smaller influence on the stock market than they did before the P word, what happened in 2020. And I have a chart here that I want to basically emphasize that this week, if we know that we're doing a lot of math, so let's go back to the S&P here, right? We're doing this math stuff where we retrace, And we're currently right on the pivot within 30 cents, right within 30 cents of the 30% retracement. We go back up to the 50, we have to be mindful of that. We fall back down to the 23 at 390, have to be mindful of that. And the reason why is because when we think about the market is only down like, I don't know, about 15% off the current all-time high. But if we're truly going into a bear market, ask yourself, am I exhibiting some of the warning signs of euphoria, or sorry, complacency, where not to spend too much time on here, but just ask yourself, if this pattern is repeating, which I've gone over before, and it says complacency is we just have to cool off for the next big rally. The more comments I see in the description that tell me that, and the more the pattern starts to match that as well. Here is our weekly closing basis on SPY for a 1 week in a line chart. So as of right now, we bounced off the uptrend. We're not violating anything. So all this means is that the pattern is still valid. We actually had a small little breach over here. And now we're back above. And complacency is what we're looking for in terms of sentiment. Hey, bros, bears, we just have to cool off for the next big rally. If that's what if that's what you're hearing, and that's what I'm currently hearing, it gives me more credence or evidence. It's not a guarantee. It is giving me evidence that maybe what I think is happening for the macro or the long-term perspective is what's unfolding. So with all of that in mind, hopefully now we understand that, yes, from day to day and from week to week, we have different perspectives because we have to adapt. We have to react to the incoming data. It is important to predict, but it is more important to react because being wrong is going to happen. Staying wrong is up to you. And I'm trying to ask myself, so as a person who has a dominant bear thesis, if we're closing at the high of the week and we have a catalyst on Tuesday, Wednesday, what is probable to happen even if we're in a bear market? What is probable to happen if we're at the high of the week over last week's high and we see a negative 0.1 and a negative 0.1? Oh my goodness. Well, my risk reward right now is, well, we power slam and print a lower low. That's 5% down. What about the upside? Well, we got about 5% too. Is that worth taking a shot at? No. For me, it is not. It means I'm watching. For the most part, I'm not ready to dive back in full bull, but I'm not ready to take a position here bearish as well for a swing trade because I need more feedback. And what I'm going to try to do this weekend is to make the story a little bit simpler. So instead of going through every single little article, which I do have prepared here, I'll go through those in a few minutes to craft my story. But I'm going to give you the key dates here and just tell you what, for me, is important this week. I think that's the reason why people tune in. And please make sure to drop me a comment and smash a thumbs up if you agree. Or if you have feedback or any comment, please make sure to let me know. We read everyone and try to respond as many as we can. So key dates, and remembering that Jerome Powell told us that the totality of the data is what really matters this week. The Fed is going into a blackout period, which means that they can no longer speak. Starting today until their February 22nd meeting, which is going to be the next FOMC meeting. So there's important dates here for September, and keep in mind the totality of the data, which means we can pick and choose whatever data we want to give the outcome we want. We want to do 50, we want to do 75 basis points in September. We will choose the data support that. That's basically what I heard from Jerome. I want optionality. Red is more important. Black is important. Other ones are notable. I've taken everything from the week that is currently scheduled to give you what I think is going to happen here. So we have a 10-year note auction on Monday. That'll be important for risk sentiment because when we look here to the 10-year note, it's closing again on a closing basis. It is over our head and shoulders. It is over our resistance at 3.3. This is a record on a nearly almost 4-year closing basis on the weekly. This is actually it's higher. We've not seen a 3.3 on a weekly closing basis going all the way back to 2011. This is a decade high on a closing basis. We have an auction coming in on Monday. That is going to be important for me. Why? If the 10-year note goes up, tech stocks are supposed to go down. They're not. So there is something that is miscalculated right now, mismatched. And again, I have another article to support that later. I'm just telling you what I think is going to happen. On Tuesday, we have CPI. I showed you the screenshot from before. Expected to be negative 0.1, but headline's going to be still at 8. So what do we focus on? That it's still 8 and we have real interest rates at 2%, or that, oh my God, it's a negative 0.1. And for me, what I will be paying attention to is the theme of peaking versus peaked. I think it is a little bit premature to be calling victory on inflation, when we have signs of peaking. Being peaked will only be visible in hindsight, which is what the Fed has told us that they are paying attention to. We are going to cool the jets on rate hikes when we have evidence we have peaked, not we're peaking. So pay attention to that subtlety because it's subtle, but it's really important. And PPI is basically what feeds CPI. So if PPI tells us that we're also going down by negative 0.1 and contracting on the previous one as well, that's a preview for the future that, hey, maybe we're going to keep going down. But is negative 0.1 really that much? Answer is no. Oil inventories, because we've been hearing about more releases from the Strategic Reserve going into October from the Biden administration. Why he wants oil prices low going into the election in November. It's pretty simple to me. On the 15th, we have the East meeting, or these two countries. And then Joe Biden's going to have a meeting with the other, again, the West later in the month. This is important. We're going into an election season. And these two countries have not met since you know what happened. I don't want to say the words I'm not supposed to. So connect the dots and you'll understand what that means. They're meeting first, just like before. And then the West meets next, just like before. All this means is that it's important. And again, Jerome's going to keep that in mind as well, right? We have to. On Thursday, we get jobless claims, and we know that the jobs market is really important to the Fed right now. PMI and retail sales. The health of the businesses, the health of retail. This is really important for the Fed as well. Then we got day two, right? Yeah, day two, right? Is that the big one? I don't know. Is anything going to happen? I also don't know. I hope not. I hope nothing happens. On Friday, we got European CPI and we got U.S. consumer expectations. All these are important. For the bull or bear story, the bull story is that there's a shallow recession, which there's evidence. The path is narrowing, but there's still evidence. We're over the 50 now, right? Yeah. Whoa. One day over the 50. If we get two, it gets more strong. We start pushing higher on Tuesday, Wednesday with that CPI and PPI. Case gets even stronger, which means that I've now flipped this to being crossed out for the 200 daily, 50 weekly in sight, but I put a question mark. Why? I don't know. If it gets closer, we unscratch it out. For the bear case, there's still more evidence. 50 weekly rejection starting to repeat 2008. DXY and TNX breakouts. Let's have a look at those. 10-year note closing at a multi-decade weekly closing high. Where? Also over last week's high at 3.295. We're at 3.31 here. Look at the 2-year note. Oh no. Yeah, it's not just closing at a new 52-week high. It's closing at that multi-decade high as well, going back to 2008, actually. Yep. Oh, yes, the good old days. That is right, the good old days. And here we have not only a higher high versus the previous week, we have a higher high versus the June high. And this just means that short-term inflation expectations are rising 5% higher than last week. Bullish engulfing candle. Which one's right? The bond market or the stock market? I don't know. One's going to have a nasty correction, though. I'm confident of that. 454 unpenetrable fortress. Yes. For us to proclaim a new bull market, we have to get above 430, but we really have to get above 454 to have that hindsight or 2020 confirmation we're actually in a bull market. Deep global recession risk. Absolutely. Right. Yep. Cannot ignore that one. In terms of surprises, CPI, the totality of the data, the East meeting. Earnings season kicking off, I think actually later this week, like next week or like the week after in September, earnings season kicks off. And then not for this week, but for the following week, the SEP, the summary of economic projections. That's what I think can move the market this week. We also want to keep in mind that for where we are currently rallying to, there are bear market targets that we cannot ignore. So if now we're thinking about the progress we have made to the upside, let's look at SPY here. And what do we know? Well, we note that we're currently at about 406. So what does that mean? It means we started at the all-time high. We started cutting down, right? Boop, 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 all the way down to 360s. Now we're boop, 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 rallying back up. We've reclaimed the 2021 low, reclaimed the 2020 high, taken back over the negative 20% drop at 384. We've gone back above 400. Oh, 432 is the next one here. Yep. One more to check off, and that's it. Or again, is it a dead cat bounce back to 400 before we go down to that negative 330? I don't know. That's why we do the why bull or why bear. It gives us the what is likely going to happen this week or probable. We talked about the losses, and just note here that The deeper the percents go, it starts to turn into 100 and then hundreds of percent for people to get their money back. And yes, over here in crypto and in ARK, we're down like -70, -30, which means there is potential to make hundreds of percent, which is what I think a lot of people are using as carrots to keep themselves motivated to keep buying. Just be mindful of the risk. That's all I'm saying. All right, so now we talked about the bull narrative. We talked about the bear narrative. I'm actually going to pull some of these back up because I want to recycle these. I think I want to keep this one here, and I want to keep this one here. I'm going to close that one out. Going to close that one out. Fed's Bullard says market underpricing higher for longer. So we have a blackout period, and the blackout period means that the Fed is not able to talk right now. But James Bullard unexpectedly had a statement to say after Jerome. What does that mean? Maybe, wink, wink, nudge, nudge. Jerome was not properly heard by who? By the markets. Fed's Bullard says markets underpricing higher for longer rates. But, right, we're singing Kumbaya. We're dancing right now. It's a bull party, right? A new bull market. So for this week, sure. When we have that FOMC meeting next week on the 22nd, oh boy, that might come back to really bite us. And someone who used to work at the Fed, Bill Dudley, the New York former governor or president, sorry. Fed will keep rates tighter for longer than expected. Bill Dudley says ex-New York Fed president sees rate at 4% or more in 2023. Dudley says it's premature to worry about over-tightening. Blah, 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 blah. The Fed funds rate at 2.33 is well below what you would consider to be a neutral in this current inflation environment. Fed policymakers have made it very clear that they need to get inflation back to 2%. So they're going to be tighter for longer. This is the theme that no one paid attention to today or this week. No one. It's very obvious. I think the 22nd is going to be a gut punch. But between now and then, hey, Justin, that's like almost 2 weeks. What about, who cares about the 21st of September? Sorry, not the 22nd. That's like a week and a half away. Let's dance right now, right? Whoop, let's do it. And that's what I think people are doing. So on the 21st, we're going to get the SEP, the Summary of Economic Projections from the FOMC, or Federal Open Market Committee for the Federal Reserve. This is when they say, hey, do we need inflation higher or lower, or are our projections correct? Right now they say 2. So if we get a CPI print that comes in at 8, but it shows 0.1, in my opinion, I think that's going to be interpreted as bullish until the Fed comes in and actually does what the market wants it to in 75 basis points and brings the big old hammer down. That's the story I have for this week in only about 20 minutes. So I want to try to keep these weekend videos to no more than 30. So I'm now going to choose some of the data to support my thesis here. I'm going to go through and have a look at a couple of charts. Then I have some more things to look at here. We're going to look at our algo platform, which includes some algo alerts, some options. Then we're going to look at the options chain. And then I think we're going to probably leave it there. All right, so the S&P here, I'm just going to go through some charts to briefly explain what I'm noticing as a theme out there. So I've talked about the bull case, talked about the bear case. Now let's look and see what evidence we have. So S&P here, again, we got a Fibonacci retracement, which gives us these dotted lines here. We have a red megaphone. We got a green uptrend. Easy to understand. If we look at QQQ, what do we know? What did it not save? Oh, it didn't. Let me go back here. Let me change these back to red. So for me, the story is pretty clear. When I look at these weekly charts here, and we're mostly going to focus on weekly charts today. I'm not going to dive down into the daily charts because it's a weekly review, so we'll focus on those. Same red megaphone, same Fibonacci levels, same -20 instead of -10. And then we note that, there's still an apex here. Yeah, so whatever happens to SPY, we're going to see that confirmation on QQQ too. QQQ also has a bullish engulfing candle. Took out last week's low, took out last week's high. Last week's high is 307.22. The close is 307.09, which means it was within about 13 cents of closing above last week's high, which means it's equally as bullish as the S&P, but a little bit less versus last week's high. Percentage, it closed higher, but the pattern for me is clear. We're clearly trending down, but there's a chance, an opportunity. Is it going to get seized? Let's see the bulls do it. DXY, closing -0.5 on the week, largely due to the euro and the Canadian dollar, both having a 75 basis point rate hike done from the central banks. So yeah, we got a higher high, we got a higher low, but oh my God, we closed red. Yep. VIX, nasty plunge here, negative 10%. And I think there's a reason for that. Like I'm going to lay out a little bit later. I think I might have already done that with the Fed thing. Yep. 2-year note up big, 5%. You think the stocks did well this week? Man, you should have seen the 2-year note, which normally does not move massive percents, 5%. 10-year note up 3.7. What did that do? Well, it gave you a bigger return than the S&P. Give you almost as good a return as the QQQ. The 2-year note beat QQQ though. Interesting. The Russell here again bouncing off the 200 weekly. Not quite above last week's high. Nice candle though, 4%. FDAX, same thing as IWM. So small caps in the US are roughly equal to what is happening in Germany. That makes sense. Oil, unchanged on the week. Is our massive cup and handle going to unfold? I don't know. This is like a long-term pattern. I think yes. And it's perfectly coming into my handle. Gold, closing the week up. Also holding on to its massive megaphone pattern here. Sorry, it's pod and handle. When I take this to a log scale and I go back to, why isn't it going back far enough here? Anyways, we have a pod and handle here going back to the 1980s to 2000s, which is the current monetary policy era that we're currently comparing ourselves to, and also inflation. So I'm paying a note to it. And same thing here, bouncing off the handle and the 200 weekly. It's starting to look interesting to me. On arithmetic, it's just not as obvious. BTC, holding the key areas we were talking about. So here it's bouncing off the 2017 high, and it's resting right here at 21,000, just at our weekly downtrend. So if it can break out, I'm watching 23,000 for the 200 weekly. Ethereum, bouncing perfectly off the 2018 high. We also know that we're back above 1,700 or the relative low. We've stopped going down from this perspective. Let's see if we can reclaim a longer downtrend. That seems like the more important one. That's right. So that is the absolute downtrend, but it's making good progress. Cannot deny that. Up nearly 9% on the week. Apple right here below its 50 weekly and also its 50 daily. It's really at a key spot here. Microsoft pointing down, head and shoulders, key pivot at 270. Goog still pointing down, so I should actually make these ones red. I'll do this after the video's done, but going forward, I'll use the color to explain the dominant pattern. Drop me a comment and let me know if you think that's going to be relevant or helpful. Amazon, rejecting off of the resistance pocket here before, still a W or a cup and handle. Bullish engulfing, higher high, higher low over last week's high. Looks good, needs volume. Tesla, 29843, 29968. It is over its 50 weekly. It is starting to invalidate its head and shoulders pattern once again. Let's see if it can actually hold it. Get above 300, confirm over 320. Meta, up 5.5 on the week. I think it's because Apple did not announce an AR/VR at their big event this week. That's the reason why I think it happened. They're like, oh my God, no competition for right now. Higher high, higher low over last week's high. NVIDIA, it's got some work to do. It's got to get to 160. Why? Bitcoin's there. Other trillion-dollar companies are doing well. This is just the, again, certain country that is having a little bit of trouble right now. DIA, back inside the demand pocket above 320s. RSP or equal weight S&P, back inside that same pocket as well. New York Stock Exchange, back inside the same pocket. XLK still stuck, 127 versus 141, still a head and shoulders pattern. It's looking a little better, needs volume. Russell bouncing off the 2018, 2020 highs, and we noted is back where? Back inside that supply and demand pocket. ARK, right here to its relative low at roughly 46. Let's see if it can bounce, send the vol. XLV, bouncing off support below the 50 weekly, but pretty close, a lot closer than other ETFs. Looks like an IHS. Bouncing off support, trying to enter a resistance. That is financials. Massively bullish engulfing candle. Bullish. That also tells you something too. What that means to you versus what it means to me is going to probably be different. Energy closing out up. There we go. Dragonfly Doji candle. Massive dub. Bouncing off the 50 weekly. Let's see what happens. Utilities. Looks good. Over the 50. Pod and handle. Looks like it wants to go up. Utilities are bullish. Inflation is in play. FXI, bearish, but less bearish than last week by a little bit. EEM, or emerging markets, it's still holding its long-term IHS here. So again, it's trying to carve one out. Carving out takes a long time. I don't know if it's going to hold it either. So it's doing okay. All right, moving on to the next part of the show. So now we're going to go through here and quickly, it's already at 30 minutes. I'm going to try to do this in no more than 5. And here we go. Forced buying puts a floor under stocks nobody else wants to own. We talked about it. Short sellers, option hedgers, quants seen driving an up week. Scott Miner calls for the S&P to drop 20% by mid-October. This guy manages a lot of money, billions and billions. We should see a really sharp adjustment in prices really fast. When? I think it's going to be when we have that SEP come out. That is just my suspicion. That's what I think he sees. On the other side, we got Cathie Woods here, right? Who's going to win? Scott Miner or Cathie Wood? Cathie Wood calls for a significant Fed policy pivot in 3 to 6 months. Says deflation looms. Deflation, that is correct. Is she going to get her evidence with that negative 0.1% print? On the green team, we got Cathie. On the red team, we got Scott. And what I believe is that I think we're going to get both. I think we're going to get the short-term bounce. I think we're going to get the long-term cut. And what they're basically saying is, I think the Fed's going to do this, or I think the Fed's going to do that. What's really important for me, if I just go to a screen here where I can just draw, what I think is really important is that when we look back in time, the market is basically saying, I will believe it when I see it, Jerome, because in 2018 and 2020, you blinked, buddy. You blinked hard. You blinked in 2018. You blinked in 2020. You're going to blink again here because the message is loud and clear. It is ringing. The bond market heard it. The stock market did not. Because as I pointed out before, for the bond market to be making new highs means the S&P should be at 360 because they're inversely correlated. So if the bond market is already back to where it was in a high or higher as it was in June, the S&P needs to drop down here. That's what Scott Minard is saying. We got to go down, baby. And Cathie's just saying, don't sell my stocks no more. No more outflows, please. So that's what I'm hearing. Cathie's got a long-term perspective. And Scott is providing us, hey, I think 20% by mid-October. Whoa, 20% in the next, 45 days? Woof. Cathie Wood is calling for a 3 to 6 month horizon. Who's going to be right? Man, that's quite some call here by Scott. I think I see what he's seeing. Who's going to be right? I don't know. Hindsight will be 2020. So the market is currently pricing in. You're going to blink. You're going to blink. And Scott is saying, I think you blink. I think you go. I think you go big. You go bigly. You go massively. You make the market go bye-bye. And I buy that dip. That's what I hear Scott versus Cathie. How earnings relate to the recession. So consensus right now is for EPS growth of 4 and 6% in the next 2 quarters. If it comes in negative, oh boy. And the Wall Street Journal tells us that most S&P 500 companies cited recession during quarters earnings call since 2010. So if this next earnings season comes in soft, that could be in hindsight, that's why we're down. I kind of get it. I'm gonna kind of skip this one here. Certain country invading another country, a distinct threat. That's from Jake Sullivan. I'm not going to read it. You can do that yourself. This is back from September. This was published on September 7th, telling us that Xi and Putin set for first meeting since a certain country. Other country. There you go. And then on the West team, right? East meets West. We've got Biden to host leaders of Pacific Island nations on September 28 to 29. And that is from the White House. Ooh, right. East meets West. Who's going to win? It's going to be all or nothing, right? Sweepstakes. We'll try to leave it there. Trying to put a positive spin on it because that's all I can really try to do. It's not really looking all that positive. Global bonds tumble into their first bear market in a generation. Oh, that's no big deal. Why? Again, we're not here to explain everything. I'm just trying to tell a story. There's a video here if you want to watch it. Global bonds in first bear market in a generation. Powell's totality of data prolongs bond market's limbo state. And again, what's that limbo state? It tells us that we're going up, baby. We're going up. We're going up. We're going up. They're saying, I don't think the Fed's going to blink. That's what they're basically saying because we're over that 2018 high. And we are at a new multi-decade high on a closing basis. The bond market's like, I don't think this guy's going to blink. I don't think so. We're playing chicken, but I think he's going to do it. The U.S. housing market downturn will be worse in 2023. Forecasts Goldman Sachs because of 2 charts. Spiking in mortgage rates are no joke. The number of households no longer qualify for a 400,000 shift in mortgages. It's the lowest since December, which means affordability is down. And mortgage payment to income ratio is now at 33, or a new high, even versus 2007, which was when we had the collapse, which means there is a deep, dark winter coming next year. Goldman's Hatsia sees encouraging signs that the economy could still achieve a soft landing. The path is narrow. And then 2 days later, stock market still in a bear phase, sees bumpy road to recovery, which means Jerome is there. He's the perfect pilot. He's trying to make it onto the strip. He's trying not to crash. Trying, might, hopeful, narrow. Those are the words I hear. Surge in real rates hits every asset as on Wall Street and beyond. Yes, including the global bond market, including stocks, including SPACs, including Bitcoin, including everything. Fed is in a blackout period, but we had a surprise announcement from James Bullard. Right? James Bullard tells us that he leans more strongly towards a third 75 basis point hike. Fed's Bullard says markets underpricing higher for longer rates. Fed's Mester need to raise policy rate to a little above 4% and hold for all of next year. Market is not forecasting that right now. See no rate cuts in 2023. Market's still currently pricing in 25 basis points of cuts for 2023 as of Friday, which means this is incorrect. The Fed pivot is not here. It is we are going to pause, not pivot. That's what the market is currently not pricing in. Expect inflation to fall in 2023, but won't be near 2% by the end of the year. Bill Dudley, Fed will keep rates tighter for longer than expected. All right, explains that they won't make the same mistakes on QT this time they did in 2018 either. The highlighted things we talked about before. What this all comes down to is the SEP, so the Summary of Economic Projections, which is going to come out on the 21st. Are these numbers high enough? I don't think so. They're all telling you, right? 4% for this year and next year, which means these numbers have to come up. 2023, 2024 have to come up. They look a little silly right now with this 4.3 number here in 2022. I don't know. Don't look down, but inflation might be cooling off. And we note that because, again, we were declining for a little bit, then we went sideways. So down, sideways, down. If we're chartists, we know what that means. It means lower highs, lower lows, at least for now. That's what we're looking for. That's what the market's expecting. However, Powell is looking well past the next inflation report. Market bulls think next week consumer price index report will be the catalyst that allows the Federal Reserve to turn less hawkish. They better think again. All right, this is he's perking up here, right? He's perked up. Powell says Fed will act forthfully until inflation job is done. And the next day, Bullard's out there yapping again. I wonder why. Maybe the reaction he wanted was not materialized on the tape, and we're due for a nastier reaction on the 21st. Maybe. I don't know. We'll see if these numbers here are going to get higher. The takeaway for me is this. Higher for longer is what we're hearing for rates. Peaking versus peaked is what I'm looking for on inflation. Moving on to the next final things here at 37 minutes. Drop me a comment. I'll see what I can do. Trying to make it as short as possible. Looking back to our algo evidence, we have going all the way back to June 1st. In order, we had the Russell alerting at 188 for an investment, which is generally going to be for 3+ months. That was back in June. Here we are. 3 months later, we're back to where we started, 187. For SPY, that came off on July 18th. And that here is at 388. We back tested it within 10 cents this week, 20 cents, whatever. And then we mooned right back to 406, which means this SPY alert is valid. We have a TNX, DXY, PSQ, SH, and RWM invest alerts, which are also all valid, which means that there is competing evidence, which means that kangaroo that I mentioned before is at play here. It's also confirming it. And we had, I think, 420 alerts this week for swings, which means there is a lot of short-term swing potential setting up. What could that do? Release into Wednesday, which is when we have CPI and PPI. And then in terms of options, we have a roughly 50-50 mix here between puts and calls at 48 and 52. And all the largest orders are still mostly puts, which means that this looks like either naked betting or hedging. Final things for us to go through, and trying to keep the video as tight as possible, but it's still 40. So I'll try my best to regroup and make it shorter next week. But I think this template or this format's going to work a lot better after doing, I think I've done, I did the math. I've done more than 100,000 hours of uploaded content on YouTube. every time it gets better. And I'm hoping that this new channel and this new format that people are enjoying. I know that because people always come back on the weekends and they always show love and support. So thank you very much. Looking at the 12th here, I note that it's really concentrated at about 408 to 405. 405s have about $3 in premium. So that makes sense. Why? Well, break even for the 405s is at 408. On the put side, we got 405 as the focus to 400. See if that converts to open interest. Going into Wednesday. Oh, I forgot. We got OPEX next week. I forgot to put that in the calendar. Oh, yeah. Right. Oh, yes. OPEX. I forgot about that. Oopsies. September for Wednesday, we got roughly 406 to 405. And then the same thing, 405 to 400 put spread. And then we got really volume coming in at 405 up to 410. It's really here at about 407. Why? Well, look at the premium, baby. It's about 3. But they gained about 1.5 on the day, which means roughly 407 to 408 is going to be where these things get break even. 407, 408, same numbers. And if we look here at SPY on the weekly chart, we'll realize whether or not 408 is important. Yes. It's not quite to 410, but it's making progress. It means a weekly higher high. Oops, I looked at the 9th by accident. So that was the Friday one by accident. My apologies. I'm just going to leave that in there. Anyways, going forward, on the 14th, we've got 400 and 405 is the same area. On the call side, oh, we got open interest here too. Interesting. So it really looks like 405 to 410 as well. Same thing. We got more volume on the put side, but the bulls are doing okay over here too. So it seems like 400 or 410 is really the number. And that is why, oh man, it's an all or nothing sweepstakes on Friday where we got OPEX just before the Fed has their FOMC meeting on the 21st, the following Wednesday. Let's squeeze out who's going to get paid, who's not going to get paid. Oh boy, same thing here, 406, 405 down to 400, that same number here. Interesting. And then we got volume really starting here at about 405, goes over here to 410. So again, same thing. We got a call spread. In terms of open interest, this right here is really the biggest one. It's at 400 put. It's a little bit more even, but both teams seem motivated. 400 put versus the 410 call. Same numbers, all or nothing. And I think we're going to leave it there. So thank you for tuning in. I really appreciate your support. And since this is a bullish video, we're going to leave you one here at the end, which gives you the bull potential, which we laid out a few weeks ago. And otherwise, I wish you all the best of luck this week. And as always, thank you for watching, and I look forward to seeing you on the next one. Thank you.